Basic bar and candlestick formations. In this video, you will learn basic bar formations, basic candlestick formations, and reversal candles. Bar charts are often referred to as open, high, low, close charts because they incorporate all important data. The distance from high to low represents the range of each time period. Bar charts allow traders to identify patterns easily by comparing two consecutive bars. One of these patterns is the key reversal. A bearish key reversal is formed at the market top and is recognized with prices surging to a new high, usually significantly higher than the previous trading day, only to reverse lower and close below the previous bar's close. A bullish key reversal is formed at the bottom of a decline and is recognized with prices first collapsing to a new low, followed by a recovery to above the previous bar's high and closing up on the day. A bearish two-bar reversal occurs at the market top and is recognized with prices opening at the same level as yesterday, but then closing lower with the same low as the previous bar. A bullish two-bar reversal occurs at the market bottom and is recognized with prices opening at the same level as yesterday, but then closing higher with the same high as the previous bar. A bearish inside day occurs at the market top and is recognized with prices staying within the range of the previous bar, failing to make either a new high or a new low from the previous bar. A bullish inside day occurs at the market bottom and is recognized with prices staying inside the previous bar, failing to make either a new high or a new low from the previous bar. A bearish outside day occurs at the market top and is recognized with prices surging to new highs, usually significantly higher than the previous trading day, only to reverse lower and close below the previous bar's low. A bullish outside day occurs at the bottom of a decline and is recognized with prices first collapsing to new lows, followed by a recovery above the previous bar's high and close above the previous bar's high. Note that outside days are stronger signals than key reversals and two-bar reversals. The spike is the only reversal bar signal whereby the color remains the same. A bearish spike occurs at the market top and is recognized with prices surging to a new high, usually significantly higher than the previous trading day, only to reverse lower and close near the open level, but higher than the previous bar close. A bullish spike occurs at the bottom of a decline and is recognized with prices first collapsing to a new low, followed by a recovery higher and a close near the open level, but lower than the previous bar close. Japanese candlesticks. Candlestick analysis was first used in Japan during the 16th century. It was used by rice traders in an attempt to forecast future rice prices. Japanese candlesticks are leading indicators because they provide early warning signals to possible price changes. Patterns of one candlestick or more can help traders identify trend continuations and reversals. As we have seen before, a candle is made up of the rectangular part, the difference between the open and the close, called the body, and the upper and lower shadows, which show the difference between the body and the high and the body and the low. When analyzing a candlestick, the first important element is the color of the body. A green candle is bullish, while a red candle is bearish. The second element is the size of the body. A large body indicates that either buyers or sellers were winning. For example, a large red candle shows that sellers were clearly in control. A small candlestick represents a consolidation of price, where there was no clear winner between buyers and sellers. The third important element is the length of the upper and lower shadows. The longer the shadows, the more volatile the price action. The various combinations of color, body size, and shadow length can be analyzed to predict future price movements. A well-known type of candle is the doji candlestick. Dojis have no body, because they have the same or almost same open and close price. They generally suggest indecision or a struggle between buyers and sellers, and therefore are considered neutral patterns. Any bullish or bearish bias depends on the prior trend, with confirmation coming from the candle after the doji. While doji is the name given to any candle that shares its open and close price, the length of the shadow may vary, allowing for a distinction between types of dojis. A doji with relatively small shadows is also known as a classic doji. A doji with large upper and lower shadows is known as a long-legged doji. A doji with no upper shadow, but a very long lower shadow, is known as a dragonfly doji. A doji with no lower shadow, but a very long upper shadow, is known as a gravestone doji. Candlestick patterns can be very popular when looking for tops and bottoms in the market. A popular reversal pattern is the bearish engulfing. It is formed at the end of an uptrend and is considered a bearish signal. A red body is formed that opens higher and closes lower than the previous green candle. The bullish engulfing is the direct opposite to the bearish pattern and is formed at the end of a downtrend and is considered a bullish signal. A green body is formed that opens lower and closes higher than the previous red candle. The dark cloud is formed at the end of an uptrend and is considered a bearish signal. The first day of the pattern is a strong green body. The next candle opens above the previous day's high, but eventually closes lower than 50% of the previous green body. The piercing pattern is formed at the end of a downtrend and is considered a bullish signal. The last candle opens sharply under the low of the previous candle, but then comes up closing above 50% of the red candle's body. The evening star is found at the end of an uptrend. The evening star, the planet Venus, occurs just before the darkness sets in and is considered bearish. The pattern consists of 3 candles. A large green body followed by a small body, which can be green or red. The third candlestick is a red body that closes well into the large green candle body. The morning star is the exact opposite of the evening star and is formed at the end of a downtrend and is considered a bullish signal. Like the morning star, the planet Mercury, it foretells the sunrise or the rising of prices and is considered bullish. A large red body is followed by a small body, and then the third candlestick is a green body that closes well into the large red candle body. The shooting star is formed at the end of an uptrend and is considered bearish. It is made up of a small red body with a long upper shadow, 2 to 3 times the body, and a very small or no lower shadow. The hammer is formed at the end of a downtrend and is considered bullish. It is made up of a small green body with a long lower shadow, 2 to 3 times the body, and a very small or no upper shadow. These patterns require further confirmation, which could come from the following candle. In our next video, we will talk about the basic concepts of trends. Thank you for watching.